A lot of people don't know where to start when it comes to time to choose what to invest their money in. What's the best investment for you? There's a lot of general advice out there, but the truth is, it's different for everyone. It depends on how much risk you can take with your money and how much time you want to spend managing your money. We will look at all the main investment vehicles available on the market, and we will rank them based on their risk reward and their complexity to understand. This will leave you with all the information and the tools you need to make the right investment decision for your specific situation. Let's jump right in. Stocks, the most popular and well-known type of investment. This is the bread and butter of investing. Now, what is a stock? The simplest explanation is, a stock is a part of ownership in a company. Not all companies have stocks. If you try to buy shares, for example, of the big accounting firms like Deloitte, PwC, or Ernst & Young, you won't be able to. That's because they're not listed. But if you try to buy shares of companies like Tesla, Apple, or Google, you will be able to. That's because all companies have a choice. They're either private, like Deloitte or PwC, or they're public, like Apple or Google. Public companies have all gone through what's called an initial public offering, or IPO. All companies are created privately. They are fully owned by their founders. Then, at some point, the founders might choose to make their company public. They first start by evaluating the value of the company and then choose a number of shares. That is, in how many parts they want to separate the ownership of the company. Or they directly choose a share price. Then they choose a date, the date of their IPO. And from that day, anyone who wishes to buy a part of ownership, a share of the company, can do so. That's why we say a company has gone public. It is now owned by the public, multiple people like you and me who buy and sell shares on the stock market. A stock is the most basic form of investment and very easy to understand. The risk reward for a single individual stock pick, however, can vary from very low for big establishments like banks or multinationals to very high for cheap stocks on the OTC market. For beginners, I strongly recommend sticking to listed stocks, meaning stocks that are approved and follow the regulations of formal exchanges, of which there are a lot, like the NYSE or the Nasdaq, for example. For your benefit, the OTC market, which stands for over-the-counter market, also known as pink sheets before, is a market where all the companies who don't qualify for the standard stock exchanges go. Your neighbor who builds stuff out of his garage could be listed on the OTC market. I personally avoid trading anything on this market. As a beginner, I would completely avoid venturing into this. So on average, any individual stock pick is moderately risky. ETFs and mutual funds. Those are two types of investment funds. A fund is simply a bunch of money collected from a lot of people that is invested in a specific combination of investment vehicles. People put their money into the fund knowing it will be invested following a specific recipe that they like. The only difference between an ETF, exchange-traded fund, and a mutual fund is how they're bought and sold. An ETF is bought and sold on the stock market just like any stock you would buy. A mutual fund is only traded once a day at the end of the day and can only be bought or sold through a financial advisor or directly with the mutual fund company. There are infinitely many combinations of funds you can imagine, but the most popular by far is the index fund. Let's break this down into its two components: index and funds. What's an index? An index is just a fancy word we use to call a group of stocks we put together to track and analyze their performance over time. The most popular indices are the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite. You can search those indices and look up exactly which stocks are included in them. The S&P 500 has the 500 most valuable public companies in the US, and is often seen as a representation of the US economy. The Dow Jones has only 30 companies within it, but they are the 30 most valuable and the most financially stable companies in the US, also called blue chip companies. The Nasdaq has more than 2,500 companies from a lot of countries, all listed on the Nasdaq stock exchange. It is weighted towards the technology sector, meaning a lot of the companies in the index are related to technology. So you understand now, an index fund is an ETF or a mutual fund that replicates the composition of an index. For example, the biggest ETF is the SPY, an index fund that replicates the S&P 500 and is managed by a company called State Street Global Advisors, or SSGA. It's valued currently in April 2024 at $524 billion US. Index funds are relatively easy to understand and they're seen as less risky than individual stock picks, but they're still exposed to market corrections or full-on market crashes. This is where CDs and bonds come in. CDs are certificates of deposits and bonds are the safest investment on the market. When you get a certificate of deposit or GIC in Canada, you're basically loaning a certain amount of money to a bank for a certain amount of time, and when the term ends, you're guaranteed to get all your money back plus interests defined on the contract. Even if the bank was to go bankrupt, CDs and GICs are guaranteed up to a certain amount by the government. This is what makes this type of investment the safest on the market. But since it's very safe, you will never get a high return. Basically just a bit more than a savings account. Bonds are similar to CDs and GICs. The only difference is you can sell and buy bonds from other investors, but you cannot sell your CD or your GIC to another investor because it's an agreement between you personally and the bank. Bonds can be issued by a company or the government, and they're usually used by them to raise money. Since bonds can be traded, their price will go up and down following the central bank interest rates. If the central bank interest rate increases higher than the yield, the percentage of interest you get out of your bond, then your bond price will go lower because it's not worth as much, since bonds with higher yields can be issued to new investors. Bonds are not insured by the government like CDs or GICs are. They are only backed by the institution that issued them in the first place. That would be either the government or the company that you bought it from. Another interesting fact, in the case of bankruptcy, bondholders will get paid first before the stockholders, which increases even more the low risk associated with this type of investment. REITs. Now dipping our toes into real estate. If you don't want to be buying a physical property and rent it out, REITs are the next best thing related to real estate. REITs, or real estate investment trusts, are companies you can buy and sell shares, much like any other stock on major stock exchanges. What's different about those companies is in how they operate. There are several rules, strict rules they need to follow just to be able to qualify as a REIT. In the US, those rules are 75% of assets, stuff they own, need to be real estate, cash, or US treasuries. 75% of their income must be related to real estate. 90% of their taxable income must be paid out to investors in the form of dividends. These rules are what make REITs the ideal investment for people who want to get exposure to the real estate market and get regular income in the form of dividend monthly from those investments. So REITs are not too complicated to understand. They're companies who buy real estate and pay out the rent they collect to shareholders monthly in the form of dividends. The real estate sector being what it is, this type of investment is mostly low risk. You basically only have to watch out for change in interest rates, which affect mortgages and in turn affect the real estate activity and drives the prices up or down. If you like following the real estate market trends, this type of investment might be for you. Forex, foreign exchange trading, yet another completely different type of investment. Forex trading is trading currencies. It's buying a currency and betting its value will increase compared to another base currency. For example, I could bet that the Japanese yen will increase in value when compared to the US dollar. I would then buy some Japanese yen with US dollars, wait a month, and then sell it to hopefully get a higher amount of US dollars than I had to begin with. This is the basic understanding of Forex trading, but there's much more behind this. Global economies are very difficult to predict, and Forex trading is basically trying to predict the strength of economies around the world against each other. Currencies, for the most part, move rather slowly. But the Forex market is very liquid, meaning you can trade with a lot of money and never be afraid to find people to exchange your money with. This is why it's very attractive for some investors to trade Forex with leverage, meaning you borrow money to increase your positions, increasing your potential gains and also your potential losses, which is why I consider Forex trading as moderately risky. If you're the type of person to closely follow international news, or you have an interest in macroeconomics, definitely look into Forex trading as it might be very interesting for you. Cryptocurrencies. You've most likely heard about this one already. That's Bitcoin and all the other digital currencies. There's a lot to learn about how cryptocurrencies actually work, but the crypto part of the word refers to how secure the transactions are because they are encrypted. It also takes advantage of a decentralized network, meaning it is practically impossible to hack. A lot of the interest in cryptocurrencies comes from that decentralization, meaning the currency is not controlled by a bank or a government. It's controlled by all the people using the currency itself. Understanding cryptos is not the easiest thing in the world. It's a hard concept to wrap your mind around. There are so many cryptocurrencies you can buy that go absolutely nowhere. It's a pretty risky investment. Even Bitcoin, the flagship of cryptocurrencies, can double or half its value on a single good or bad news. Some people only swear by cryptocurrencies, but I would advise you to be careful and not to listen to any guru that tells you that this new crypto is going to go to the moon. No matter what, cryptocurrencies are risky business, so only invest what you can afford to lose. Talking about risky, now we arrived at the king of them all. Options and futures. Futures and options are contracts offering a possibility or an obligation to buy a certain stock, the underlying asset, at a certain price, the strike price, at or by a certain date. By buying an option or future, you're not buying a stock directly. You're buying an opportunity to buy a stock in the future at a price you think will be advantageous. In the case of options, you have the options to go through with the purchase. But for futures, you have the obligation by the expiration date to go through with the purchase, unless you sell your contract to someone else. But if the contract is not advantageous, no one is going to buy it off from you. Options and futures are at the same time very complicated to understand and very risky. No beginner investor jumps right into this type of investment, and most people never touch it, but it can be a very useful tool for financial professionals to hedge the risk. Now that we have an overview of the main investment types, it's much easier to see which one might be the best choice for your specific situation. How much risk are you able to take with your money, and how much time do you want to spend managing your money? Those are the two questions you need to answer to make the best decision for your investment future. There's also something that's so easy to forget. Invest in what you feel comfortable with, and invest in what you understand. If you follow this advice, you will be starting your investment journey on the right foot. If you're actually struggling to get started because you're asking, is this the right time for me? Are we in a recession? What about all the bad international conflicts going on, wars, elections? Well, stop wondering and watch this video to get all the answers to your questions.